Two things are happening in the silver market simultaneously right now. They cannot both be right, and one of them is about to destroy the other. On one side, it is surprised, China's physical silver vaults are draining at a rate that has not been seen in modern market history. Physical reserves depleting session by session, supply-demand imbalance reaching levels that are ringing structural alarm bells across the industry. The paper market gradually losing its grip on price discovery. On the other side, a Chinese billionaire who made nearly $3 billion riding gold's historic rally, who then made over $1 billion yuan riding silver's rally from the long side, has just built the largest net short position in silver on the Shanghai Futures Exchange. Curious 450 tons of silver, roughly 30,000 contracts, shorted at the exact all-time high, and he is currently sitting on paper gains of approximately $288 million. Physical vaults draining. The most successful precious metals trader in China short 450 tons at the peak. These two realities cannot coexist forever. Either the physical scarcity forces prices higher and destroys his position, or his bearish thesis proves correct and silver has significantly further to fall. One of these views will win. The resolution will be violent in one direction or the other. This entire video is built around understanding both sides with complete precision, so you can watch the indicators that will tell you which one is right before the mainstream figures it out. Stay in. Let us start with the physical supply picture in China, because this is the foundation everything else is built on. China is the world's largest consumer of industrial silver. Demand from electronics, solar panels, renewable energy infrastructure, electric vehicles, it is enormous, structural, and growing. Every solar panel requires silver. Every electric vehicle uses significantly more silver than a combustion engine vehicle. The renewable energy transition alone is creating a demand curve for silver that did not exist in any previous market cycle, and supply cannot respond to that demand quickly. Silver is primarily mined as a byproduct of other metals: zinc, lead, copper. There are very few primary silver mines. When demand for base metals is soft, silver supply decreases even if silver demand is increasing. Supply inelasticity meeting structural demand growth. Higher prices do not quickly generate more supply. It takes years to bring new silver production online. Against that backdrop, physical silver reserves in China are depleting at a rate that should concern anyone paying attention. In normal functioning markets, the paper price and the physical price of a commodity should be closely aligned. The futures market is supposed to be a derivative of the physical market. But when vaults run dry while futures prices fall, you get a dislocation. You get a situation where the paper price loses credibility. And historically, when that happens, one of two things occurs. Either the paper price eventually catches up to physical reality and moves sharply higher, or physical holders are forced to sell at paper prices and the physical market capitulates to paper. Right now, both outcomes are live. The tension between them is building toward resolution. Now, the man betting hundreds of millions of dollars against that physical thesis. His name is Bian Shimming. He operates largely through Shanghai Futures Company. He keeps a low profile, spending much of his time in Gibraltar, rarely speaking publicly. But in China's futures markets, he has built a legendary reputation. Since early 2022, his bullish positions in Shanghai Futures Exchange gold contracts have delivered nearly $3 billion in profits. $3 billion. That makes him one of the most successful precious metals traders in the world. This is not a speculator making directional guesses. This is someone with a documented track record of understanding precious metals markets at the deepest institutional level, who called gold's historic rally correctly and rode it for 3 years. And here is what makes his current position so analytically significant. He was not always short silver. He built a large long position in silver starting in August last year. He generated over 1.3 billion yuan in profits from that long position. Then in November, he began to reverse course. He attempted to call the peak of the silver rally. He rode silver up and made over $1 billion yuan. Then he flipped short near what he believed was the top. He successfully traded both sides of the silver market. Now here is the specific timing that matters. Exchange data shows Bian Shimming began aggressively increasing his silver short position in the final week of January. His short exposure rose to approximately 18,000 lots on January 28th. It expanded to approximately 28,000 lots by January 30th. January 30th was the day silver prices in Shanghai hit an all-time high. He was shorting into the peak, fading the rally at its absolute maximum. The trade was not without pain. During silver's rapid price swings, he was forced to liquidate some positions at a loss as the metal continued surging higher. He took significant pain before the trade worked, but he consolidated his short exposure across longer-dated contracts and held the position through renewed volatility. The subsequent sell-off validated his strategy. Silver declined more than 16% in the week following the peak. That decline generated an estimated paper gain of approximately 2 billion yuan, roughly $288 million. Accounting for the losses taken during the earlier rally, his net profit on the position is estimated at approximately 1 billion yuan. And silver's decline has continued, increasing the value of his short exposure further. The man who made $3 billion long gold, made over $1 billion long silver, then flipped short at the exact all-time high, is currently sitting on another billion yuan in profits. When someone with that track record makes that kind of move, the analytical obligation is to understand his thesis completely, not dismiss it. Let us examine the bearish case with full precision, because Bian Shimming's $288 million paper gain demands it. The bearish thesis goes like this. Silver's recent surge was not driven by sustainable fundamental demand. It was an industrial move amplified by speculative positioning. Too much hot money entered the trade too quickly, positioning became crowded, and when crowded positions unwind, prices can fall dramatically. Here is the institutional characterization of silver that the bearish case rests on. Gold is viewed by institutional investors as a legitimate monetary hedge. Central banks buy gold. Reserve managers allocate to gold. It has a documented monetary role in the modern financial system. Silver, by contrast, is increasingly characterized by institutional capital as a volatile, industrial, and speculative metal. Its price swings are amplified by retail and speculative flows. And when those flows reverse, the price collapse can be severe. Bian Shimming appears to believe silver got ahead of itself, that the rally was overdone, that speculative froth needed to be cleared out. And so far, the market is proving him right. There is also the supply-response argument that most bullish silver analysis refuses to engage with honestly. Physical tightness does not necessarily resolve through higher prices. If holders of physical silver decide to sell, if industrial users work through their inventories more efficiently, if scrap supply increases in response to elevated prices, the supply situation can improve without prices needing to spike. Markets are adaptive. High prices cure high prices by incentivizing supply and rationing demand. The bearish case says the smart money, represented by traders like Bian Shimming who have made billions in these markets, sees speculative excess where retail bulls see structural shortage. They see a crowded trade, they see prices that ran too far too fast, and they are positioned to profit from the correction. Now the bullish case, with equal precision, because the physical vault data demands it too. The bullish thesis is this. Physical reality eventually overwhelms paper positioning. You cannot run vaults dry and expect paper prices to remain suppressed indefinitely. At some point, someone needs to deliver actual metal, and if the metal is not there, the paper price must adjust. China's depleting silver reserves are not a temporary phenomenon driven by speculative positioning. They reflect a structural supply-demand imbalance that is getting worse, not better. Industrial demand is broad-based and growing. Solar photovoltaic installations growing exponentially, each gigawatt of capacity requiring significant silver. Electric vehicle production ramping globally. 5G infrastructure build-out consuming silver. Medical applications using silver for its antimicrobial properties. Electronics proliferation continuing. Industrial demand is structural across multiple end-use categories simultaneously. Meanwhile, supply cannot respond quickly. Most silver comes as a byproduct from base metal mines. If zinc and copper prices are soft, those mines reduce production and silver supply falls regardless of the silver price. Supply elasticity is structurally low. Higher prices do not quickly generate more supply. Now consider the risk arithmetic from the short side. Bian Shimming is short 450 tons of silver. That is an enormous position. If physical tightness becomes acute, if short squeeze dynamics take hold, if he cannot roll his contracts or is forced to cover, his losses could be catastrophic. He already had to liquidate some positions at a loss during the earlier rally. What happens if that dynamic repeats but more violently? What happens if the physical market dislocates further and his counterparties demand delivery he cannot make? Paper shorts do not create physical silver. If the metal is not available, paper prices must eventually reflect that reality. There is also the central bank dynamic that provides structural support beneath the entire precious metals complex. Central banks are accumulating gold at record rates. Their buying signals a deep and broad distrust of fiat currency systems. That sentiment does not stay contained within gold. It spills over into silver markets. The bullish case says we are in a secular bull market for precious metals driven by currency debasement, geopolitical uncertainty, and central bank diversification away from dollar reserves. Corrections happen within that secular bull market. They shake out weak hands. They allow strong hands to accumulate at better prices, but the direction of the larger trend is up. The core question is whether Bian Shimming is right in the short term but catastrophically wrong in the medium term, or whether he is reading a structural peak that the physical data has not yet confirmed. Now the layer that adds the most critical context to this entire binary setup, and it is context that was not available when Bian Shimming built his position. This week, simultaneously with his 450-ton short position sitting at maximum paper profit, COMEX Silver Delivery Week went live with data that is unlike anything seen in modern market history. At the start of this delivery cycle, COMEX had 86.13 million ounces of registered silver, 10,526 contracts filed for physical delivery on first notice day. That is 52.63 million ounces, 61% of the entire registered inventory, demanded in a single delivery cycle. Normal delivery months see 2% to 5% of contracts standing for physical delivery. 74.38 million ounces have already been delivered in this cycle, with demand still outstanding. Started with 86 million, delivered 74 million, demand still coming. When the paper market felt that physical pressure, silver spiked to $90.10 intraday. Then COMEX circuit breakers activated and crashed the price back to 80.57. Scotiabank issuing 249 delivery notices in a single day. BNP Paribas stopping 255. Global banks, not retail investors, using COMEX exactly as it was designed, to take physical metal. This is the physical reality that Bian Shimming's paper short position is sitting against. Not the speculative froth he shorted in January, the acute institutional delivery demand of March. The binary question at the center of this script, physical scarcity versus paper dominance, is being answered in real time through COMEX delivery notices published every single morning this week. Which side is winning depends on which data you are reading. Here is the framework for determining which side wins. 6 specific indicators. First, the Shanghai premium relative to Western paper prices. If Shanghai premiums remain elevated above $10 while paper prices continue falling, physical demand in China is robust, and the bearish narrative is losing ground in the physical market regardless of what the paper price shows. If Shanghai premiums collapse and align with falling futures prices, the physical demand story was overstated and the bearish case gains significant credibility. Second, dealer inventory and retail availability. If major physical silver dealers continue reporting difficulty sourcing metal, if retail premiums stay elevated above normal levels, if mints report backlogs and allocation constraints, the physical scarcity thesis is confirmed in the retail delivery chain. If dealer inventories normalize and metal becomes freely available at paper prices, the supply constraint was temporary and the bearish correction can extend further. Third, exchange-registered inventory across COMEX, Shanghai, and London simultaneously. If inventory continues declining across all 3 exchanges, the drain is systemic, not exchange-specific. If inventory stabilizes or begins rebuilding at any major exchange, physical inflows are responding to the price correction and the supply floor may be forming. Fourth, commitment of traders positioning data. If commercial short positions remain extended and crowded, short covering could trigger violent upside moves with very little buying required to move price significantly. If speculative long positioning is still crowded and unwinding, further liquidation can drive additional paper price weakness before the structural floor asserts itself. Fifth, Bian Shimming's position itself. This is the most direct signal available for the paper side of this trade. Bloomberg and exchange data will continue reporting on his exposure. If he starts covering, if his short position of 30,000 contracts begins declining, that signals even the most profitable and most informed short seller in China believes the trade has run its course. That covering signal would be one of the strongest available confirmation signals that the bottom is forming. If he maintains or expands his short, continued conviction in lower prices from the trader with the best track record in this market. Watch his position as carefully as you watch the vault data. Sixth, industrial demand indicators. Chinese manufacturing PMIs, solar installation numbers, electric vehicle sales, semiconductor production figures. These drive the structural demand floor beneath silver. Strong industrial data confirms the demand side of the physical thesis. Disappointing industrial data undermines it and supports the bearish case that the demand story was priced ahead of reality. One specific nuance worth addressing directly. Recent Chinese State Council discussions of advancing the silver economy do not refer to the precious metal. The silver economy in Chinese policy language refers to economic opportunities related to the country's aging silver-haired population, demographics, elderly care, retirement services, not precious metals investment. When headlines reference China's silver economy, read the context before drawing any conclusion about silver demand. That is the kind of detail that separates informed analysis from reactive decision-making. The bear case for silver holders needs to be stated with full precision. Bian Shimming has a documented track record that demands analytical respect. He made $3 billion being long gold, made over $1 billion being long silver, then correctly identified the speculative peak and is now profitable by hundreds of millions of dollars on the short side. That is not luck. That is pattern recognition at the highest institutional level. If his thesis is correct, that the silver rally was built on speculative excess rather than durable fundamental demand, then the correction from the January all-time high has further to run. Silver at $80.47 today is already down significantly from the $120 peak earlier this year. If the COMEX delivery stress is resolved through emergency cash settlements and delivery deferrals rather than inventory exhaustion, if the Shanghai premium compresses as Chinese buyers step back, if industrial demand data from China disappoints, then the paper price has no structural floor preventing a test of $77 or lower. The dollar remaining above 100 on the DXY adds mechanical downward pressure to every dollar-denominated commodity simultaneously. And a Fed hawkish surprise on Wednesday, dot plot eliminating cuts or any member advocating a potential hike, drops silver $1.0 to $2.50 in the first 15 minutes of the FOMC reaction. The structural case being intact does not mean the paper price cannot move significantly lower before physical reality forces the resolution. If you are over-leveraged, if you are holding with money you cannot afford to lose through a sustained drawdown, the margin call will take you out regardless of whether you are ultimately right about the direction. Manage risk before the market manages it for you. For those holding silver positions and feeling the weight of this setup, 3 points worth sitting with. Ask yourself whether anything about your fundamental thesis has actually changed. If you own physical silver as a hedge against currency debasement or because of structural industrial demand, a paper price correction driven by the largest informed short seller in China does not invalidate that thesis. It tests your conviction and shakes out leverage positions. It does not change the vault drain data. It does not change the delivery notice data. It does not change the solar demand trajectory. Second, separate your time horizon from your thesis. Bian Shimming may be right in the short term and wrong in the medium term, or he may be right in both. The data will tell you which. Watch the 6 indicators, not the paper price, to determine which narrative is winning. Third, do not follow anyone blindly. Not this analysis, not billionaire traders, not any source on any platform. Evaluate the evidence. Consider both sides. Make your own decisions. The silver market is at the most significant binary inflection point in this entire cycle. Physical scarcity versus the most informed short position in China. The resolution will be determined by which data breaks first. Here is where the market stands. Chinese physical silver vaults draining at historically extreme rates. Bian Shimming, who made $3 billion on gold and $1 billion on silver from the long side, short 450 tons at the exact all-time high. Currently profitable by approximately $288 million on that position. COMEX this week delivering 74.38 million ounces against 86.13 million registered, with institutional delivery demand still outstanding. Shanghai premium still elevated above paper prices despite the correction. Scotiabank and BNP Paribas still signing delivery notices for physical metal. And the Fed meeting Wednesday with language that could either accelerate the paper selling or reverse it completely. Two forces directly opposed, both backed by real data and real capital. The physical vault drain says prices must go higher. The largest informed short position in China says prices have further to fall. One of these views will prove correct. Watch the Shanghai Premium daily. Watch COMEX registered inventory every morning. Watch dealer availability and retail premiums. Watch the COT positioning data weekly. Watch Bian Shimming's position. If he covers, that is the signal. Watch Chinese industrial indicators monthly. 6 indicators, all publicly available, all telling you which side is winning in real time. The data is public. The mechanics are understandable. The only requirement is the discipline to watch both sides with equal precision, and let the data determine the conclusion rather than letting the conclusion determine which data you read. Verify everything in this video. Shanghai Futures Exchange data is publicly available. Bloomberg analysis of exchange positioning is on the public record. COMEX delivery notices and registered inventory are updated daily. COT reports are released by the CFTC every week. Chinese industrial data is published monthly by the National Bureau of Statistics. The data is there, both sides of it. Read both with equal rigor. Invest with logic, not hype. Market Crux, signing off. Market Crux, all data independently verifiable, not financial advice.